Tonight we have two sessions. The first session is the Financing Sources panel, where you're going to get to meet people who are actually investors and have dealt with investors at different types of investors. And a lot of the time in class here, especially given the nature of the technologies that tend to come out of MIT, people assume, you know, I gotta go the VC route, the venture capital route. And I wanted to show you a video from the Kauffman Foundation for about 4 minutes that really talks about where do people get funding. So I'm going to switch that on now.
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings. Whether it's a few $100s or even thousands of dollars, that's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings, and then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital, and the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kauffman research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them, it's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because, you know, venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that had become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, you know, Bob's your uncle, run. You know, keep all the equity because, you know, there's no better thing than being in full control of your own destiny.
Good, so that gives you at least a view of it. The Kauffman Foundation is the largest single foundation devoted to entrepreneurship, and there's a lot of good stuff that they have there, and you should check it out from time to time. With that, I'll invite the panel to come up, and Julianne Zimmerman is the moderator who assembled the panel, and I'll let you introduce, and I'm going to get rid of my computer here. Thank you.
So, good evening, everyone. Is the mic on now? Yes, awesome. And our third panelist is running behind. So she'll be here as soon as she can. we have 3 outstanding panelists who have very different perspectives and very different experience to share with you. Before we get started talking, I'm really curious who's in the room. So first of all, by show of hands, who has already launched a new enterprise? Okay, and of those of you who have launched, do you have revenues? Any, by hands, anybody have revenues? Okay. And for those of you who have not launched, are you preparing to launch imminently? So this term or in the next 6 months? Okay. And by sector, how many are in health, pharma, biotech? Okay. How many in digital media of any kind? Okay. How about hardware? Okay. Materials. Anybody? 1. Okay. How about communications, transportation, or infrastructure? All right. Cool. So a little bit of a sense. There are lots of other sectors, obviously. Consumer? Retail? Okay. There are lots of other sectors, obviously, but those have really different parameters. So that's a good starting point, right? So we have some sense of who our audience members are. Okay, so the way that we're going to undertake this discussion during this session, as Joe said, is really to explore the different kinds of capital that are available to you that you may want to explore as a founder, depending on the appropriate needs and purposes for that funding to fuel your business. We're going to try to talk to you about some of the pros and cons or costs and benefits, but we're going to do that in a really conversational way, and I promise to save some time at the end for Q&A. So without further ado, Lacey, would you start by telling us about your perspective, your experience with raising and deploying capital in the startup world?
Yeah, certainly. So just for context, yes. So just for context, I work at an organization called Alumni Ventures Group, and we kind of run a family of sort of micro venture capital funds that all sort of sit under this, one larger parent company umbrella, and they all have affiliations with various universities. So we have an MIT fund called Castor Ventures, in addition to kind of funds from most Ivy Leagues and a number of other schools like Stanford, Berkeley, Northwestern in our family as well. And so we invest anywhere from the institutional seed stage all the way through later stage growth rounds. So, my perspective that I can bring to the table here is, just sort of coaching, young founders or folks like out of, school and kind of having, helping them understand their journey. And oftentimes, venture is a great, attractive, interesting option, but it comes with sort of a baggage of, constraints, I guess is the best way of putting it, associated with them. So, for us to participate in a particular round, we're looking at financings kind of at the institutional seed stage, which in this market, there is some sort of traction, and that can be defined in various different ways on a per sector basis, whether it's, you have certain research, in a lab that you've already proven that's effective and you're kind of going out to commercialize it, but you're going after a really large market. Or it might be, you did a bunch of user testing and sort of built out an MVP of a product, and you're kind of, going out to see, use that money that you're raising from the round to invest in sort of customer acquisition and scale. But you have something. It's more than just a PowerPoint and an idea. And sort of that $2 million institutional seed, it puts you on a path that is a little bit different than if you were to kind of explore via, many of the other options illustrated in the video. So, happy to, as we kind of go on in this class, kind of talk sort of about those trade-offs and kind of about what we've seen, success stories, kind of go down that venture path, the traditional venture route, but also some of the pitfalls as well. Hopefully that's helpful.
So Monica, before you start, everybody, our third panelist has joined us. Thank you, Betty. So glad you're here. So Betty, just so you know, we're just starting off with a little bit of like 3 to 5 minutes about your perspective, raising and deploying capital in the startup realm. Okay, so Monica, please.
Oh, these are heavy. Hi, I'm Monica Profit. I'm a serial entrepreneur. I'm currently launching my 5th company. It's in the real estate and technology space, also employing blockchain technology, called Rise Housing. That's how Julianne and I first got to know each other, through some mutual friends and media sources that are mostly in the blockchain and technology space. So my background has been in multiple different sectors. I've launched companies that had to do with more hospitality, arts and culture, things that straddled the nonprofit and for-profit world, especially in arts and culture. And for me, I kind of went through my question about how many cooks needed to be in the kitchen to begin with, from just a board perspective in the arts and culture space, when I was looking at hybridizing a for-profit and nonprofit type of model. And that's been a big part of what's informed my approach to raising money and how I launch other companies that are strictly in for-profit space now. So I hope that I can speak a bit to you about just the different ways that I've launched companies. They've mostly been in the earliest the earliest ways that people launch, which are through savings and credit cards. I actually used to open up most of my talks with my last company with, here's my company, it's brought to you by Visa and MasterCard, because especially in the arts and culture world, people didn't like to talk about needing to raise debt to get through a mission that was very, social impact and mission driven, but that's the reality. So I think looking at all the ways that you can personally back what you're doing is, it's been a big part of what's driven my approach.
Hi, everyone. So my name is Betty Francisco, and I'm actually a corporate lawyer. I started my career about 20 years ago in a law firm, and a lot of the work that I did was representing VC firms as they were investing in companies. Also represented early stage tech and biotech companies. So that is how I got into understanding, what is involved with raising money, what are all the legal terms involved with raising money, and how onerous they can be sometimes. Fast forward, currently I work for a nonprofit as their general counsel, but I also do angel investing through Pipeline Angels, and also some other angel groups like Astia. And it got me focused on, some of the issues surrounding women entrepreneurs in particular, who have a lot of challenges raising money. So Pipeline Angels is a boot camp to teach women how to invest, ideally, so they'll create capital for women entrepreneurs, and that's mostly who I invest in. I also invest in entrepreneurs of color, and I see really early stage companies. Some of them, have already launched, have products. Some have revenues, even up to $1 million, and we're looking at those too. But I'll say that, for me, my focus and passion is really about how do we create more money for a demographic that's been underrepresented and undervalued. So we could talk about that piece too.
Awesome. So actually, I'm going to come right back to you, Betty, because one of the things that we hear all the time in the startup world is about this friends and family round. Right? Mm-hmm. So if you don't come from a household that has significant savings you can tap, or that has, significant family wealth you can draw on, if you don't have an Aunt Matilda you can go to and, ask her to basically back you in your initial stages, what are some of the other sources for the very, very earliest capital? So there are angels and angel groups, but what else is available at that very, very early stage if you don't have access to family capital?
Right. I mean, I would say sort of how you start, it's bootstrapping, right? So it's everything from credit cards, leveraging, credit. It might be some savings that you have. I mean, some businesses start and can immediately generate revenue, so it might be just pumping back what you're making into the business. Some of the things like you all have heard of crowdfunding, right? So if you have something that you're testing and you want to sell, there's crowdfunding platforms that you could use to see if your product, is of interest to the market, and that can generate some revenue too. There's also early debt, like Acción, for example, which is micro lending. So those organizations might look at really, really early stage organizations. I don't know that they'll just fund an idea, but they will certainly look at you if you've started. And then I'd also say that there's grants, there's pitch money. So if, there's tons of these startup competitions where literally you could do an amazing pitch and just have an idea and win money. And I know some companies out of the Babson Win Lab, I actually did that program for a separate company I started, and there was one entrepreneur that has raised, I think, almost $400,000 in pitch money. So that's another creative way to generate revenue.
And non-dilutive. So does everybody know these terms, dilutive and non-dilutive funding? Anybody not know? It's okay. Okay, good. So dilutive funding. What's dilutive funding, Lacey?
Sure. Dilutive funding is effectively when you seek investment in exchange for a piece of ownership in your company. So oftentimes that happens at the friends and family stage if they're sophisticated enough and it isn't, maybe your mom lending you money. But it comes in a form of, it's a piece of paper, and effectively that can be in a variety of different mechanisms. In today's market, that's often either via convertible note or something that's called a SAFE, which is a simple agreement for future equity. And they're effectively the same thing, and they're just ways to say, hey, we'll give you X amount of money, and in the future, when you raise that priced equity round, we'll want a piece of that at a potential discount to that. So I would say most institutional paths, people aren't, just benevolent people handing out dollars. They kind of want something in exchange, and that's sort of where dilution kicks in.
So just to be clear, what dilution means is diluting your ownership, right? So as a founder, before you have anything else, you have ownership of your idea, maybe a patent, maybe a copyright, maybe some other intellectual property, a trade secret, and it's yours. Once you take in any sort of equity investment, then you are diluting your ownership, right? Because you're essentially selling off bits of the company. What are some non-dilutive ways to raise capital, Monica?
I just want to add that with the dilutive ways of raising capital, also you can potentially be giving away authority to make decisions.
Absolutely.
So if somebody owns even a very small minority piece of your company because they paid you some small amount of money for it, or maybe some sizable amount of money, they may or may not be able to help you with your decision-making processes, which could really hinder, or if it's the right investor, it could really help you in terms of pushing things forward or being able to be agile, pivot in the market, listen to your customers, and respond. So if you have out-of-touch people that happen to own part of your company, they could actually stop you from doing what you think is best, even though you're a majority shareholder. So I just want to put that in as well. Dilution is not the only potential
We'll come
drawback.
back to that in a few minutes.
But some non-dilutive ways are, again, credit cards, doing your own savings, making sure that you can pool your own resources, getting the right people on your team that might want to invest their own money as a co-founder. I had one co-founder in one company who brought in most of the money because I brought in most of the expertise, and that was fantastic. We both really knew our domains. It was almost like a well-formulated marriage. It was very traditional. Like I tended to one part of this and he tended to the other. We didn't step on each other's feet. So, you can structure ways with the right, again, it has a lot to do with community and network though. So, having not myself come from a family with a lot of money that I could go and tap and find the friends and family wasn't going to really get me very much more than a cup of coffee. So I ended up, expanding really intentionally my community professionally and making sure that as I nurtured that, I was bearing in mind the types of ventures I was going to want to do in the future or things I was currently doing. And not to be totally transactional about things, but I think when we talk about value and creation of value and resources that are non-dilutive, human capital is non-dilutive in the sense that it doesn't hurt me at all to get to know you, and it doesn't dilute what you already have to bring to share it with me if it's just a matter of your knowledge or your desire to go grab a cup of coffee or your friendship. So that source of resources is like one of the most valuable ones that I've come across. And from that comes all kinds of amazing dilutive and non-dilutive sources of intelligence, IP, and also, early investment.
What experience do the three of you have with founders who are bootstrapping? So either growing based on revenues or operating their business in the early stages as a side hustle and basically funding their early operations with a job, a full-time job, or with pre-sales. Can you give some examples?
I've never been so happy to be laid off from work as when I had a great business I really wanted to throw myself into. I mean, of course, I made less money on unemployment, but I had all of my time, and that was when I started thinking again about resources in terms of time being so valuable. In fact, potentially exponentially more valuable than my actual paycheck. So I traded in, dinners and stuff, or dinners out and clothes or whatever, and shopping for like investment in something that had much more value to me, which was time in what I wanted to do.
I mean, I would say a lot of the companies that I meet, the founders have already decided to do it full time. There have been some that I've met that are still working, right? And I would say if you have a job that's giving you your source of income to live, and you're able to get your business off the ground, keep it for as long as you can, right? So is it Sarah Blakely, right, from Spanx?
Yeah.
Tells a story about, I think she worked up to the time she even was generating $1 million in sales, right?
I think it was more than that, actually. It was
maybe
10 million, yeah.
So she just, wanted to have the security of the job, the salary, the one that gives you healthcare benefits. That's really important. It's important to live and feel like you're financially secure while working on your business. If you don't have that luxury, then, it's a challenge, right? To be generating enough revenue where you can use it for living and also growing the business. So I always recommend staying in your job for as long as possible, or if you get laid off, get a really good severance package.
Yeah.
What about pre-sale? So what about using Kickstarter or any of the other platforms?
think they're
Where is
great.
that well aligned with a founder's interests?
Well, if you have a prototype, a product, so there's, I'm trying to remember. So there's one founder I know, she's making, it's called Unruly Studio. She's making the Splats brand. And she, she's working on her venture full time, but she launched them on, was it Kickstarter? I can't
don't
remember
remember which one,
I know I
either.
bought them in pre-sale. But she was testing the market. So these splats are basically, it's a product for kids. It's used to teach kids how to code, and they basically code this pad that looks like a splat. And it lights up, so kids can exercise on it, they can jump on it, and it's a coding tool. So she's bootstrapped through pitch competitions. She even applied, I think, for an SBIR grant. She's done a bunch of fundraising, and has done some angel fundraising, but she launched on Kickstarter, I think it was Kickstarter, and raised enough to then be able to produce the first set of product and ship it. So I bought it, my kids are testing it for me, but it's one way to see, do people really want this, right? And then what are the kinks in it? Because I think you want to also see, does it really work the way you thought it would, especially with a product like that.
Yeah, so if you have a product that sells to individuals, to households, to consumers, and you want to launch it, a pre-sale campaign on Kickstarter or another can be a vastly better way to do it than to go through all of the process of developing a manufacturing relationship and paying to roll out your first product line without knowing if you actually have customers. So a Kickstarter campaign is not free to put together. It takes effort and some cost. And I'm using Kickstarter generally for the category. But if you can generate significant sales in advance of production, which is why it's called pre-sale, then you have a pretty good idea of who at least your initial customers are. And not only that, but you have your initial sales lined up. There are several examples of companies out of MIT, as a matter of fact, who have had wildly successful pre-sale campaigns that have actually launched them. And the interesting thing is, you've probably seen this, Lacey, I'm guessing, that companies you mentioned have traction. Pre-sales can be a significant form of traction.
Definitely. I think, the whole advent of Kickstarter, Indiegogo, whatever crowdfunding platform, it just gives entrepreneurs optionality. I think, you able to test the market in a very capital efficient manner, especially if you're producing something, you're able to get orders before you're having to outlay the capital to produce the goods. And then you kind of see the results. And from there you can say, these are the metrics under which, I think, this business could be. These are, my customers. These are what they're willing to pay. This is kind of the demand I got in a certain period of time. And that is very interesting in many businesses to venture capital. And so you've been able to take, your idea, de-risk it a little bit, bring it to life, show that initial traction, and put yourself on the path that venture capitalists definitely, there's some that even kind of have an algorithm that sits over a lot of these Indiegogo and Kickstarter campaigns that just monitor them for, interest and traction. But it also, you can leave that at the end of the day and also say, look, I'm going to bootstrap this further because there's a couple things, I want to continue to control my own destiny. I don't want to give away a percentage of my business and dilute my ownership, and you can keep rolling. It kind of puts you further on a decision tree that still gives you power at each node.
And if you're selling a product or a service to a commercial customer, so if it's a B2B proposition, what experience do any of you have with companies that are using non-recurring engineering or other contracts to generate those initial revenues? Where have you seen that successful?
I'm not sure if this answers your question, but so if you're selling B2B, depending on your customer, I would go straight to a chamber of commerce, right? To big corporations that have procurement departments that want your product or service, if it is that type of product or service. If you getting in front of big companies when you're very early, my husband works at State Street and people are constantly pitching things at him. He's like, we just don't buy from startups. That's their line. Mm-hmm. And so you've got to show a little bit of traction. And if you could just land one corporate client, that's a way into then other corporate procurement departments. And the chambers, the Greater Boston Chamber of Commerce, has, I think, initiatives around small business. There's also government contracting. So working through municipalities, the city of Cambridge, city of Boston, do you have something that they want? And you can become, if you're a woman-owned business, you can become a certified woman-operated, right, business, and that's one way in. But those are the ways I think to get to businesses, or you go the traditional route of figuring out exactly who your client is, right, as a business, and finding where do they convene, right? Are there conferences, or are there associations of those businesses? Right, it's finding where do they live and hang out.
Yeah.
So in terms of thinking about the different kinds of capital, we're going to come back to this question of alignment, I promise. In terms of thinking about the different kinds of capital and the different stages of development, what has been your experience, the three of you, and in terms of the best match of each kind of capital with the very early stages of development, and recognizing that you've seen different sectors, which is why we wanted to understand the different sectors represented here in this room. What do you see as the sort of best matchup of different forms of capital with different kinds of businesses?
I can start. I always encourage entrepreneurs to really kind of have a soul searching time to kind of figure out, more importantly, what kind of business they want. And I know people are always, dreaming big or whatnot, but it's really informs the way that they capitalize their business. So, a couple of examples are, I was talking today with this entrepreneur, and she's building this, digital health service to kind of help victims of trauma kind of less kind of connect and tell their stories and more heal. And she has a, number of, a medical background and how to kind of integrate that. But she's struggling between whether or not she wants to create this free platform and kind of have it be more of a social good-led venture, or kind of go more of the let's target health plans on day one and kind of sell into kind of a B2B play. And those are two very, very, very different businesses. It's not to say that she can't start with the more social impact bent business, get interesting early metrics that, from a, time spent in app, the types of customers she's able to attract, and then pivot later stage and kind of upsell these customers through and create a larger business at it. But those are two very different funding paths. Kind of to build that enterprise, ready product that, insurance providers are going to pay for on day one, it requires way more capital than the other. And so that, she was unsure where she wants to go, but that to me still stems from a very internal question about what kind of business you want to build and what type of expectations you're looking to kind of, take on your shoulders, I guess. So obviously there's a venture route that comes with, scaling as quickly as possible and building a very, very large business. So when you kind of take in venture money, usual terms for your round is kind of selling around 15 to 20% of your business, depending on per round. And so that investor on, moment one that's investing in your business and is for 20%, wants to turn that investment into a multi-million-dollar return for them. But if they know that you're going to need 4 more rounds of funding, that business needs to be even bigger than if you just need 1 round of funding. So the venture is just a very loaded thing, and it can be great, but it definitely comes with the expectations that you're going to push no matter what to make that big business. And so there's other forms of other people that are looking and underwrite different types of returns. They're still looking for a profitable return on their investment, don't get me wrong, but they're looking for more sensible growth, kind of more understanding about what you might be willing to do and the trade-offs associated with that. You can still invest in that social impact business that this entrepreneur is struggling with and make an amazing return. It just sort of depends on how she goes about building it and capitalizing it. So
I'm really glad you raised this question about founders' objectives and aspirations. One of the things that I ask founders whenever I meet with them is, what's your definition of success? You're embarking on this very challenging proposition because there's something you hope to achieve. There's something you hope to accomplish. What is that? And how will you know if you've been successful? And it's astonishing to me, actually, how often people will come back to me and tell me that no one has ever asked them that before, right? Because if you go pitch someone, they're interested in, how do I make money on this business proposition? They're not interested in your objectives. They're interested in, is this an opportunity for me to make a return, right? And that's regardless of whether you're talking to angels or corporate VCs or mainline VCs, or if you're talking to people who are interested in cash-on-cash returns, whether that's a royalty or other arrangement, a straight up and down debt, you name it. The person you're pitching is looking at the proposition you're putting in front of them as an investment. They're not looking at it as your dream, right? So that really brings us to this question of alignment, right? So you mentioned, Lacey, that if you get a venture investment, the venture investors are expecting a multiple return, right?
Yes.
What many people don't realize is that you're also signing up, in essence, to sell your company, right? So if you take a venture investment, you are not going to own your company in the long run.
Yeah, I think that goes back to, the terms and term sheets. It's a founder's market right now, given the amount of capital available in the venture ecosystem. And so term sheets are pretty clean these days, but oftentimes there's a lot of stuff in there that has nothing to do with necessarily money, it's control. And, I'm looking at this one investment right now, and I would say, the founder effectively started business A. Business A didn't necessarily work out, but discovered along the path business B. But the business was capitalized in a way that he was shooting for the moon and stars and, to create a multi-billion-dollar business, name brand VCs on his cap table. And, they did a complete recapitalization, which effectively means saying, you people that you thought you owned 30% of the business, you now own, 2% because we're bringing in a new investor and the valuation is completely different. But I bring that up because he now has this really interesting high growth business, but not many people in the venture ecosystem want to invest because it comes with all this baggage. So if you're an investor that's just able to look at the business and say, this is interesting, that's great, but because the traditional way funding works, people just are afraid to touch things when they have all this baggage on control in terms, and the fact that there's 12 people on the board and no one's looking to fund this. So they did get a new term sheet from another investor. Sorry, it's a long-winded story, but another investor, but this investor has aspirations to sell the business, in 3 years based on these metrics. So it hopefully will be an interesting return, but it's a very different type of control. Like the control is gone because of how he capitalized the business. And, it's unfortunate because he's been working for 6 years right now. And, he'll hopefully have something to show for it at the end, but it won't be that, it'll be $1 million exit type scenario, not $1 billion.
Well, and actually, I'll come back to you in just a second, Betty. There's a very good friend of mine who's an MIT postdoc who tells a story, and I won't tell her name or the company name because it's her story and not mine, but she tells a story about her experience co-founding a biotech company out of the work she did as a postdoc at MIT. She and her co-founders were not only successful in commercializing the idea they started with, but they ended up splitting the company into 2 companies and successfully commercializing a second technology. And by the time they got to an exit point, they had taken in so much capital in order to realize those 2 successful commercializations, both of which became the standard. The standard in the field. So hugely successful. She says that at the end of the day, she and her co-founders got to keep their middle-class roots. So they have this great story about success and big influence and big impact in their field, but not a big monetary return.
Yeah.
Right? So Betty, what were you about to share?
No, I was just going to note, with venture investing in particular, having represented VCs, the most negotiated thing is how do you get out, right? What you want to know is how do I get my money back or how do I get the return? So there's all kinds of stuff about how you get your money back, liquidation preferences if something goes really bad. But in the end, the exit is either you sell or you go public. And the VCs will put in terms into the investment that say that sometimes we can sell when we want to, right? So say it's 5 years out, 7 years out, if you haven't gotten to where they wanted you to be, they could sell. you, right? And you don't have much control. And it could be for a price that you don't like, because in the end, if the founders end up with mostly common stock, which is the, right?
In other words, what's left over
What's left
after the
over,
investors
yeah.
get theirs?
Get their money back and maybe 2 times, whatever was in those terms, right? So it's something to really look if that's the kind of money you're raising. And, you know, back to the point in your earlier question about what's your definition of success? I think there's so much focus right now on being, you know, the unicorn, being venture-backed. Success is getting venture investing, and that's not really true for everybody, right? You might be perfectly happy with a business that generates a certain amount of money, it sustains you, and you have a happy life, right? So it just depends on what kind of life you want. When I was starting, I wanted to launch a Ninja Warrior gym, and my tax guy basically painted the worst picture in the world for me. He said, let me tell you, this is what your life is going to look like in 5 years. Probably you'll have no money left. You'll never have a vacation. You know, you're going to struggle with this, and that. It's just a facet of having that kind of business. And it almost dissuaded me of ever wanting to think about it again. But I didn't, right? I was like, okay, that's your narrative. But sometimes businesses can be very, very hard. It may not be the lifestyle that you dream of. So it does involve a ton of retrospection, right? Introspection around what do you want success to look like.
And I mean, I think beyond just what you want success to look like, thinking about how you want to, what are your work habits? I mean, do you go hard and fast and nothing gets in your way? Or do you need to have that team around you and you need to have people to ask their opinions? Do you need to have, you know, a runway of 18 months right in front of you, or can you go month to month and just keep hustling, but maintain control? I think that I had a really great meeting with a friend of a friend who just took my call and said, you know, it sounds like you're raising money and it's really interesting and I love what you're doing. I have some introductions to make for you. But I'm wondering what's your fundraising strategy? And I was like, what do you mean the strategy? And he says, well, you know, there's a few schools of thought. From an entrepreneur's perspective, do you want to be raising a small round now only to have to come back soon after and raise again? Because that can take you off mission from your actual business. Or do you want to raise more significantly now and back that up with how long it's going to get you, not just in terms of runway, but maybe getting to scale faster, change how quickly you want to grow, but also hopefully make the revenue to make up for that so you're not returning to fundraising again so soon. And so I went from thinking, I'm going to raise as little capital as possible. I don't want somebody telling me what to do. I'm going to do it, you know, to suddenly thinking, oh, a significant raise now could just get that done off my plate and back to my real focus. Because I don't want to do the investor dance. That's not my job. That's not my business. I never want it to be my business. I'll do it so I can get to what the core of my actual business is that I love and that I want to see grow and that I'm happy to someday sell and hopefully make my investors happy too. But, you know, they're two very different things. And I guess it goes back for me to my experience on at a nonprofit organization that I founded, that was slightly nonprofit and for-profit, which was, you know, do I want to go the traditional nonprofit route and have all these board members who may bring in money through donations and development, but I'm going to always be returning to them to do that again and again and again? Doesn't that split my focus from the actual mission of the organization? In that case, it was arts and culture and sustaining artists and doing arts programming. But, you know, you can't split your brain that much and stay on task with the real meat of the organization. So I think whether it's for-profit or nonprofit, you have to be very careful that you don't get caught up in getting the money in the door stuff rather than, you know, in the nonprofit world, we call it the earned income model, where you just have a sustainable business that sustains this organization. And in of course, the for-profit world, it's just the bootstrapped, revenue positive, you know, steady and maybe not slow. Maybe it's got some rocket ship to it, but it's not fueled so intensely that now you've got coffers, but expectations that really maybe you could never even fulfill. And that management of those interests is taking you off mission from the actual building of the business at the growth rate that it can sustain.
Go
Yeah,
ahead.
I would say I'm often surprised at, you know, meeting with very early stage groups about what thought process kind of goes into, you know, you ask them sort of, you know, like, what are your plans? Like, you know, how much do you need to raise? And usually I often get just like you know, $1 million. And, you know, it's sort of like, okay, that could be great, but like, let's talk about like why now? What are you going to do with it? You know, I feel like it's always in the best interest of the entrepreneur to like really sit down and think about how much money they need. And it's you
Not
know,
just in the current round, but total. Total.
And so, you know, obviously the trade-off between the larger round versus, you know, a couple of different increments, pluses and minuses, like who really wants to always be fundraising? It's not that fun. Although at the same time, if you raise a smaller amount, you have a ability to further de-risk the business, potentially gain a higher valuation when you kind of go back for that you know, additional source of capital, and therefore you don't give up as much ownership, which is super important at the end. So there are pluses and minuses to everything, but I would always like encourage folks to really make, you know, a detailed model about exactly what you're going to use that money for, and you know, and then you can have conversations around, you know, I think when you go meet with folks and they're saying, you know, maybe you should grow faster, this or that, you can, you know, just listen to that feedback. But if at the end of the day, you have your own backbone for what you would use the money on, that's often the most, you know, important sort of guiding North Star about what drives you.
I've actually done the exercise now several times over where I've made the models of what I would use this much money for, what that would actually get us, what would this much money, what would that much money, because so often you can go in and talk to an investor and find out that they think you're raising too little money or they think you're raising too much. And if you can't be ready for whatever they throw at you, like the investor dance, you have to kind of think up several models. And then it's almost like a dare to dream moment where you're like, which one actually feels right? Which one is aligned with how I want this business to grow? Which one do I think I can pull off? Which one do I think that they believe me that I can pull it off? You know, but I'm ready for, yeah, well, okay, if we did have this significant investment now, here's what that would look like. And if we have this smaller investment, here's what that would look like. And sometimes you get so many strong opinions from other people that are completely disconnected from your business, but they know about capital deployment. And so they have a strong opinion and you have to be ready to volley with that at their level, with what they're talking about. So I would say run a couple of different scenarios and again, go back to what's aligned for you, because if you don't want to be raising again really soon, or if you don't want to be talking to them about every decision that you make, or if you don't want to be, you know, pushed into a position where maybe you would have to sell sooner than you'd want to, or you don't have a clear vision of when too soon or too late is for you, you know, getting back to what you want it to be is a great place to start before you go in and get other people's opinions in the mix, I think.
So we'll come back to other forms of capital, but I want to stick with this thread for a moment. So Betty, alignment and having a great, productive, collaborative, supportive relationship with your investors is the best of all possible scenarios. It obviously doesn't always go that way, but what are some ways for founders to identify and seek out and audition investors in order to find that great, productive, aligned relationship?
Yeah. No, I mean, you know, they say when you are getting investment money, you're basically going into a marriage, so to speak. I mean,
I think that's an overly benign metaphor.
It really is. I mean, so think about, you know, this is going to be a series of partners, right, that you'll have over the life of your business. And how do they align with where you see it going? So I think, you know, some of the ways to meet investors, I mean, nowadays, you know, a lot of the firms, angel investors do this a lot in some of the co-working spaces. They have office hours, you know, and so do VCs. I think, you know, it's starting to find the ones that fund your type of business. So if you're, I don't know, a biotech, right? There's a particular set of VC firms that just do biotech. If you're a particular type of tech, like if you're a SaaS company, a B2B SaaS company, again, a particular type of investor. So don't spin your wheels going to all of them. Try to be really specific about these are the ones that fund my type of business, and then figure out where to meet them. A lot of times they're looking for deal flow, right? So they want to see the latest and greatest ideas coming out, especially out of this institution. And so there's ways that you can, you know, begin to cultivate a relationship by meeting them, telling about what you're doing. It's not a pitch. It's more like a networking, you know, meeting. And you're seeking guidance, right? So part of it is to position it as, this is what I'm doing, this is what I'm thinking, can you give me some feedback? And you begin to cultivate a relationship. And I think over time, if they really like you, I mean, I've invested in companies that I met them once, maybe they did pitch or maybe they were introduced to me, and it wasn't until a year later, maybe more, that I actually did an investment because I wanted to watch them progress. But I was getting to know them, I was getting to know the founders, I was saying, is this someone that really is committed to what they're doing? Are they able to pivot? Because inevitably, your initial idea is hardly ever what you end up with. So, today I think there's a lot of interest by investors, whether angel, VC, seed, to meet entrepreneurs, and there's a ton of spaces to do it. I mean, we could talk about, where they are, co-working spaces. There's, in Boston, there's District Hall, Venn Cafe. There's spaces dedicated to facilitating these meetups.
What you
Yeah,
said
and it's
reminds-
also,
What you said reminds me of just a quick, a phrase that I got from some friends who were also raising about maybe a year or two ago. They said, if you're looking for advice, ask for money. And if you're looking for money, ask for advice. And
Yeah.
if you always just go in
Right.
saying, what is your insight? What advice do you have for me? It just opens more doors to eventually then get more than, than just advice. when you ask
Investors
for
love
money.
giving advice. So
They do.
They do.
while most founders really are expecting to essentially be auditioning for the money, right? It's really important for you to think about that you're also auditioning investors to be involved in your business. And so one of the ways you can find out who might be an aligned investor, a good investor for your business, is, as Betty said, to look at similar companies and look at the investors who have backed those companies, and then go talk to the founder teams. They're your peers. And ask them, what was that experience like? What was it like during the courtship phase? What was it like during due diligence and negotiation? What was it like post-investment? And if you hear, for example, somebody says, Betty invested in my company and it was amazing. It took her more than a year, so you want to start talking to her well in advance of needing a check from her, but here's how she was helpful to me, and here's the advice she gave me, and here are the introductions she made, and here's what it's been like to have her on my board, right? Because you're more than likely going to take on a board member. And that all sounds like it's well aligned with what you're looking for. Then ask that founder to introduce you, because that's actually one of the very best ways to meet an investor is through one of their portfolio companies. Stepping away a little bit from the venture space, Monica, you've done a lot and written about the blockchain world and the crowdfunding options that exist now that didn't even exist just a few years ago. Where does that enter into the range of options for founders?
Well, I'm not sure the ICO world is even still, limping along, especially in the U.S. right now. The ICO market is actually pretty strong still overseas in Asia. It sounds to me like most people who are wanting to raise money through initial coin offerings and cryptocurrencies of any sort, whether they're security backed or they're not, are going to Asia. So that's just a common theme, that there are different regulations over there. You can take an investment and it's not as much of a problem. And I'd like to I think of the ICO world or even the STO world which is the security token offering world, as kind of the Kickstarter of equities in companies or equities in something the company does. So again, it's sort of taking in what could be considered later as future revenue through some vehicle. And that vehicle, because it's available in a small increment of investment, it can be a crowdsourced thing. So it's not just the people, of course, that have, hundreds of thousands of dollars to deploy that you're going to talk with. It's suddenly talking to everybody just like you would Kickstarter, but with this idea of here, buy a piece of either something that you can use on our platform or buy a piece of what we're going to be making, but it's maybe not a product. So in the sense that Kickstarter is very good for product-based businesses because you can pre-sell your product and test the market, The ICO market and the cryptocurrency market, the crowdfunding approach that came from cryptocurrency of any sort, has given a lot of blockchain and crypto founders the ability to test the market, but also build community. So for companies that are very focused on B2C plays, they are going to do really well, or they're going to, that opportunity there gives them the chance to test many, many, many more things about the people that may be interested in their company and in their offer than if they couldn't use that funding vehicle. That said, if you're going to get most of your cryptocurrency-driven funding from Asia, you've got to have a pretty global offering. So it's a very strange leapfrog. It's like you've taken, you know, a standard piece of like rubber and just stretched it in the weirdest ways to come up with the shape of a crypto company now in terms of its fundraising options and where it can succeed and also fail. And let's not, just putting the failure opportunities aside, like if you take in money from unaccredited investors in the US, you can just go straight to jail. You know, like you have to be very careful. So there are a lot of really weird nuances about that. And it's its own animal. But early, before there was as much concern and regulation and also fraud, early in the process of just watching ICOs come to market, there was a lot of incredible excitement. And I think that came not so much because of the unscrupulous types of businesses that were suckering people into bad investments, even though that did happen. I think it really comes to the point that people of smaller means, small increment investors, I call us, are really hungry for opportunities. And there are a lot of really good investments out there that we don't have the chance to invest in. And blockchain and cryptocurrency are beginning to open those markets up. And it is an exciting time for that. So whether it's a matter of fundraising to help a company in its early stages, or if it's just a matter of using new technology that blockchain's enabling and crypto is enabling, there is going to be an entirely new world of investment opportunity and raising opportunity that the whole economy is going to be changing because of.
Awesome, thank you. And so let me, if I could just sort of sum that up to say, at the moment, that market is not as vibrant as it was even just like 18 months ago. It probably will reemerge in a slightly different form. But if you are doing something which is crypto or blockchain related, it may still be the appropriate community for you to be raising capital in, right?
Yeah, and even if you're not doing something that's crypto or blockchain related, that technology could become very applicable to how you raise money or how you build community and engage consumers in the pretty near future. The SEC has recently said that all cryptocurrencies are equities in companies, so it's all equity. And so if you think about, you know, how many ICOs just went through that process, it's kind of laughable, but I mean, there's a real kind of hustle on the part of the Securities Exchange Commission to catch up with what this technology is enabling that could maybe rock the boat quite a bit. So in that being equities, though, we've talked about how in the VC, when you're raising from VCs, you can end up having your ownership diluted. Well, now if you just stuck your toe into selling cryptocurrency about, you know, for your company in some other way, now the SEC is saying you've now diluted your shareholdings of your company. So it's a funny time right now. But even though that footing is really shifting, it's finding its place, and it's becoming a vehicle that's going to be applicable to people that aren't just doing blockchain and crypto-related technologies. It's just that is going to lay over well. I mean, whether it's supply chain, nonprofit work, you know, tracking of people even. I mean, there's some crypto-related and blockchain-related, like tracking of anti-human trafficking types of initiatives. They're just incredible applications for the technology. So it's not just something that's going to be for that type of business.
And so continuing down the path of non-venture capital sources, Lacey, with the alumni funds you work with, a lot of the founders have gone through government grants or other non-dilutive sources. What are the costs and benefits of those sources? So it's, you know, notoriously painful to write grant applications, but what are some of the other costs? And what are some of the benefits?
Yeah, I mean, I would say most folks that kind of make it to the institutional seed stage and kind of having, bootstrap some sort of proof of concept through non-dilutive funding, it's pretty much a benefit. They've, for the most part, proven that they have a business model that's conducive towards the venture model. And they've done it in a way that they, reduce risk in a way that didn't dilute their ownership. So they were able to kind of present a business case to venture investors that said, hey, we do command probably a much higher valuation because we have all of this, we've de-risked the business by doing X, Y, and Z, which is, it just depends on what industry they're in. So I'd say when they come to me, it's mostly a benefit. Most folks that, and I would say it doesn't just have to be at the seed stage. Like you can use non-dilutive sources of funding to de-risk your business to, multiple millions of dollars of revenue and then go out. We have an investment in our portfolio that the company, took pretty much like friends and family, like under $1 million about 9 years ago, bootstrapped the business to a $50 million run rate, and then raised at like a $400 million valuation. Which, he's built this incredible business and he owns, 75 to 80% of it. So I'd say it's pretty beneficial. I think, I can't necessarily speak to as much of the downsides to it. I view it as all positive in the venture space. The more you can kind of look outside and show traction, if you show up with a very mature business, people are going to pay you for it and you own more of it.
So one of the downsides to pursuing grant funding is that you are going to be obliged to fulfill the terms of the grant, which may or may not be what you want to be spending your time on. Just as you heard from Monica that you may or may not want to be spending your time courting investors, you may or may not want to be spending your time fulfilling the terms of the grant and reporting and the like. So again, alignment is crucial, right? If you can bring in government grants or even foundation grants, depending on the business you're in, that will pay for development you're already planning to do, again, back to the question of what your objectives are, then that's a relatively low cost. But if it pulls you off course, that becomes much more expensive, right? Because it's a big distraction. Before we get to Q&A, I would like each of you to answer one of the following questions. Either, and take your pick. Each of you can choose your own. Either, what is a really, really great success story you can point to of where everything was lined up and how did that happen? What made it be a success? Or what was a flaming disaster that you can share? And feel free to conflate the details, right? You can change the names to protect the guilty. And again, what made it a flaming disaster? Why did it become a flaming disaster? Or what is something that you think founders really ought to know before they go out to bring in any kind of capital that most founders just don't know? So a success and what made it a success, a failure and what made it a failure, or something that everyone should know and just doesn't.
Okay, I can start. I can start with a personal failure on a personal investment that I made. It was effectively in this company in the retail space, and they were making just apparel. That wasn't relatively differentiated. They had an interesting target market, but it was, just an average sweater at the end of the day. I mean, this is, of course, hindsight, me telling you this. They had a licensing agreement to license, the logos of a couple of like professional sports leagues. And so obviously understanding the licensing agreements of, the NBA, it's sort of complex. They don't just hand it out to everybody. You kind of have to get approved. So in theory, there was some sort of barrier. Effectively, they raised a bunch of angel money, kind of on a valuation that thought that they'd be like, a couple a pretty sizable multi-million-dollar business, and it just sort of didn't pan out. I mean, they didn't, the competition in the market for that space, it was just really hard for them to acquire customers, hard for them to kind of stand out and differentiate themselves and make an interesting enough margin. And so I think that's just a good example of, while great idea and interesting sort of passion project, perhaps was better capitalized through cash flow, through credit cards, like other ways than kind of raising a convertible note from angel investors. So it didn't necessarily pan out, and effectively they were able to sell the business to a strategic acquirer who effectively acquired the business for the tech and talent, meaning investors got absolutely nothing, including the founders who for the past 4 years have put their blood, sweat, and tears into their business. They now have a job at this sort of the new company, but at the end of the day. And I don't view it as a terrible outcome because, again, they're employed and, they have a home for sort of their IP or whatnot. But I would just say it was an example of an interesting sort of side business that was capitalized poorly, that, me as an early angel investor was a great life lesson. But, I think you just got to make the right decision for what meets your business.
So my story kind of hits on all three, actually. And I realized, I was like, wait, no, that's in there too. And so I think the most important thing that you got to know as a founder is yourself. I don't mean to be too, let's all sing Kumbaya about it, but honestly, I don't think that there's been any decision I've made in my life that has required me to fully want to grow in whatever way I was called to grow. And that means pivot my business, that means develop a pitch deck when I don't know how to, that means write copy that I've never written, learn how to do marketing. I mean, just all the hats that you wear, not only professionally, but personally, and overcoming the fears that can come with being outside of your comfort zone, knowing yourself and knowing your limitations and what you're really in it for, and what makes it worth it to overcome that thing you didn't want to have to do, is so important. And I think that's the most important crux of the story of what started out as sounding like such a success and now I think is just a massive failure. There's a company that got a lot of recognition in a city that I have lived in, and they had an amazing raise. They used an ICO mechanism. They went to Asia. They hit the market just at the right time, just before it all fell apart. They raised, I think, $22 million in less than 30 days. They had a dating app, and they were a huge success. They went to South Korea, and they threw lots of parties. I'm sure there was lots of nefarious activity at those parties. And they sold a bunch of cryptocurrency in their dating app, and it was a wild success. And they came back, and they got a big building, and they all piled in there and started throwing more big parties. And, now they are facing some investigations around exactly who they raised that money from, and was it all just from South Korea, or were there some people here in the States that it was actually illegal for them to take that money in? And also, are they building that dating app? Or, really, do you need $20 million to build a dating app? Who needs $20 million to build a dating app? And were you even intending to build a dating app? And those questions were never asked necessarily internally. And now they're being asked by some authorities that have a bit more of an interest and a bit more authority to bring in there and mess that person's life up and those founders' lives up. So I think did they go out to build a business? And if so, what were they building for? And again, if you're going to fundraise, yeah, that was just easy money at the time. But I think that that's the perfect idea or the story arc of how you can go the wrong way because you didn't even know what you were going in for. And maybe you were just there to earn a quick, greasy buck. But, you can kind of take it too far, too. So just knowing what you're in it for, I think, is the most important part.
Well, so I would say in terms of something that you may not know is that whatever you think you are starting with now will not be the same when you actually finish. And there's something that, it was, I think, a piece of advice when I was going through the Pipeline Angels program. There was an investor that said, the entrepreneurs that I like to work with are the ones that are focused on the problem that they're looking to solve and not on the solution, right? So, you may be trying to solve a problem and you have a particular solution to it. That solution is going to change. It's going to evolve, and you have to be able to go through the twists and turns, right, and be flexible. So I think that's one thing we sometimes get enamored, right, with what we want to do, and we think this is it, this is the only way to do it. And if you get stuck, no one will want you, no one will want to work with you, no one will want to invest in you, so you have to show flexibility. And then I would say, because I'm still an early investor, so I don't have like a wildly, I mean, all these companies are operating, thank goodness. But actually my very first investment, which was a mentor of mine said, oh, you should invest in this business, which turns out it really is not a business, but it's an amazing inventor. This person has a slate of about 15 incredible patents in the immersive technology space, and she's truly an inventor. But the business that I thought I was investing in has never happened. And so the strategy now is to take these patents, which are probably very valuable, and develop a licensing strategy.
You could speak to Joe about that.
Yeah, so it's a licensing strategy that isn't quite working, and so now it's a sue-use troll strategy. So again, the business itself is expensive right now because there's so many patents. A patent portfolio requires money to maintain, legal fees. So it's got operating expenses, but no business. So it's been like a journey for this founder, right, to figure out who do we work with that can actually do licensing deals with the patents, and if not, take a litigious strategy, right, which is suing others for infringement, which is the case. There are cases of infringement, but that's just not, I don't think that's a great business.
And it's also expensive.
But it's also expensive, right?
Yeah.
So anyway, so that's I know I'm never going to get that money back, so, but I do hope that this person succeeds launching something, one day, because the patents are incredible.
Awesome. So we have a few minutes for questions, and I want to give you a chance to engage our outstanding panel. Who has questions? Yes.
You had mentioned
Could you speak up, please?
you had mentioned weighing the pros and cons between raising short-term rounds versus spending more time to raise more money. Do you find that in the long run, companies that have to work with a smaller amount of capital end up doing better, or because they have to make the resources work?
Julie, can you repeat the question?
Yeah, so the question is about the trade-off when you're trying to decide whether to raise a small round and maybe have to raise some more capital shortly thereafter, or raise a large round, and whether there's any advantage to actually being forced to be capital efficient.
Yeah, I mean, anytime anybody can be capital efficient and kind of very tight pulse on, can hold on those purse strings, it's always for the better. I think, obviously the crazy stories about the parties and the perks in the offices, the ping pong tables, like, it's just a little nuts. I think especially as a founder, that's coming out of your own pocket. I'd say the trade-off is my day job, your day job as a founder is running your business. And when you get distracted by 15 meetings a day with investors, how do you best use your time and manage? You want just enough money that you're not every month having 15 meetings a day, that's unsustainable, but you also don't want to raise too much money that you're kind of sitting idle and then 6 months pass and you haven't accomplished anything because you're like, oh, I got money in the bank. So I think it's that push and pull, and it's that constant battle. And, as mentioned before, the more money you raise, the more sort of you give away of your company at a particular valuation. If you can raise slightly less capital at that point and kind of grow the business and show a ton of traction, you can raise additional capital at a higher valuation, which further, protects your ownership stake in the business. So it's a trade-off.
Yeah, I agree. It is a trade-off. But I also feel like you can, if you know that you can handle bootstrapping, do it for absolutely as long as possible, always, no matter what. And if you can even take money in stages and say like, okay, maybe we'll just hit these milestones and then take the next little bit of it and be able to have flexibility in that, it's to your advantage. But then again, I fall on the side of bootstrapping, you know, in my experience. So I can't speak too much to having a more inflated budget and moving with a lot of additional extra capital. So I still say try to raise as little as possible.
So,
Yes.
how do the founders could figure out how much money they need and how could they set a milestone, you know, if they don't have a business background?
That's a great question. So the question is, how, as a first-time founder, do you figure out how much capital you're going to need in order to achieve your ultimate objective, and what reasonable milestones are? So I'll take a first crack at that, and then anybody else who wants to disagree or add. Really, the best way to do that is to start off by looking at comparables. So what are similar companies to yours, right? How much did it take for them to reach full commercial success or whatever your objective may be? And what did that look like? And you'll find that there are norms across sectors, right? So the norm in the pharma sector is pretty well established, right? The norm in the SaaS sector is pretty well established. And, you know, on and on. So if you look at comparables, that'll give you a pretty good idea. And then you should also cultivate a really, really good set of advisors, either formal advisors or mentors who are knowledgeable, who can guide you to adjust those models to the specifics of your business. But it's ultimately up to you as the founder to be the one who's owning those. And so you really do need to learn as much as possible about what the, not only what the norms are in your sector, but what the range is, right? And what your options really look like. Does that make sense? Anybody else want to?
Yeah, no, that's right. And I think sometimes you can also calculate that you want to get up to a certain point, right? So you might want to get to the point where you develop a technology up to right before commercialization, and then you, right, either sell it or you work with a strategic partner to commercialize it for you. But you know you need this much to get to that point. You know, like I'll give you an example. There's a company called Allergy Amulet, a woman entrepreneur that I met. She has this technology basically to test for food allergies. And she knows, I forget exactly how much, but she knows that she's probably going to need in the range of, you know, 6 to 8 million to get it to market and grow it. I think she's raised almost 2, but it's been a super long journey for her. And each raise is to get to a milestone, right? So one milestone is to be able to develop the prototype. The next milestone is then to do, you know, one sampling with trials. The next, so you develop like particular milestones you want to reach, and you know exactly how much capital you need to get there.
One more question before we end this session. Yes.
You mentioned before for B2C market to test, for example, on platforms like Kickstarter and so on. But if you're just a startup and you just develop this thing you want to bring to the market, you need to protect your intellectual property. And that's costs. For example, of course you can go with provisional patent and so on. It's not so expensive. But if you want to protect it, every patent lawyer will tell you that don't disclose the idea before filing and so on, and it costs pretty much money. So with Kickstarter testing, so how would you advise me to proceed? For example, if idea is quite risky to be copied.
So again, I'll take a first cut at it, and please disagree or elaborate. And by the way, Joe is substantially more expert on this subject. But depending on the product, the IP is not necessarily the feature set, right? And it's not necessarily what your customers are buying. right? So it's very likely the means in which you make that feature set compelling or different. And so to offer a product is not necessarily to disclose the underlying IP. But you do want to make sure that you have very good advice about what constitutes a disclosure, right? You may decide, and you have a whole session on IP, don't you? Oh, excellent. Stay tuned. Anybody else want to add anything? Okay, you are all amazing and wonderful, and I wish you all success. Please thank our wonderful panel.